Kalimera Anthropos, welcome everybody to OIKONOMIKA, all about economics and finance. And as usual, super happy to be with you all today. We have a great content. So if you're new around here, please subscribe to OIKONOMIKA, all about economics and finance. I will provide you with the most in-depth macroeconomic and econometric research about the economy, financial market, financial assets, what bonds are doing, what currencies are doing, what's going on with the economic growth, so forth and so on. All the major topics of discussion about the economy we will cover here together at OIKONOMIKA, which in Greek means economy. So today we have a huge content. I have analyzed 160 data columns variables with 140 rows. I have taken the bulk of UK macroeconomic data starting for the first quarter of 1989 up to the latest quarter in 2025. You can see here my huge Excel work here. There is a huge load of data. Here we have this fancy chart that I was just extrapolating myself what is the real bank rate. So actually the Bank of England, it's the real yield on the sterling money market money, it's slightly negative, so it's already an accommodative, a slightly easing bank rate. So with all this data we will see together what actually is going on in the UK economy and what are the structural features, the cyclical stuff, and we will understand with much clarity the real thing. Okay, so the beauty of doing macroeconomic research is that we can understand in real terms what is good, not what is good, what is bad, what actually, how the economy works, what are its characteristics. And so we can, after that, we can understand what are, in theory, okay, without being so egregious, in theory, what are the policies or the decisions that one would have to take to improve things for the overall, for the whole of society, okay? So let's get stuck in. And okay, so we will start here. We'll start to see with a macroeconomic dashboard just a couple of things. We are using, what we are visualizing here, it's two linear regressions. One is Hawkins law, and the other one is the classic Phillips curve. So these are two linear regressions which basically explain, which tell us if my thing works, okay, what are the linear regression outcomes between economic growth and unemployment, or between and also between unemployment and inflation. So we can start to see something very interesting. Here we have Hawkins law coefficients. The slope is 0.014, the intercept is minus 0.002, the R square is 0.046. The P statistical value, etc. So what we can extrapolate from this is something very simple. Okay, the R square, it's very small, so that means that the strength of the linear relationship between economic growth, the GDP in Britain, and unemployment is not very strong. Okay, and here we have the slope coefficient and the intercept. So for argument's sake, we can say that the Hawkins law, not YOT, not YOT, it's actually what is the delta in the unemployment. It's equal to what? To minus 0.00002 plus the slope factor, which is 0.0146 times GDP. Okay, so what that means times GDP. Okay, so what that means is every 1% of gross domestic product, the improvement in the unemployment rate is 0.0146, which is let's make it 0.15%. So somebody will say, okay, no, but the coefficient is positive, So it means that GDP goes up, unemployment goes up. No, the improvement in unemployment rate. So for every 1% of GDP, okay, the UK economy this year it's growing between 1.3 1.5% GDP. So that means that according to this linear regression, the marginal improvement in the unemployment rate would be a reduction of 0.15%. And that's very minimal because on average, in other advanced economies, the relationship would be 0.4, 0.5. So for every 1% of economic growth, you have 0.5% improvement in unemployment. So it means that unemployment shrinks by 0.5 percentage point. But in the UK, you have this coefficient that I have estimated, that anybody can estimate or guesstimate, and we see that we have economic growth, but then unemployment it doesn't really improve that dramatically. And we can see another thing here, which is correlated to Okun's law, because we analyze here what goes on between economic growth, inflation, and the actual labor force, right? So here we have the Phillips curve. So we have unemployment and inflation. And basically the song remains the same. So that the slope of the Phillips curve in this linear regression model, because I have so many estimates, so it's not an absolute factor. So the slope of the Phillips curve parameter here is minus 0.0573. So it's a parameter, it's a number, anybody can see, it's very, very small. It's very close to zero. And you can see here the slope of the curve is slightly negative, but it's almost close to zero. So what that means that in general terms, unemployment it's not a proper or a good factor in the economy to explain inflation surprises. So as a matter of fact, if anybody who lives in Britain who knows that doing a grocery shop or buying certain things, or paying for utilities like gas, electricity, or water rates, or council tax, it's very expensive, and unemployment keeps going up. So that doesn't mean that the level of aggregate demand, AD, is directly correlated to inflation, to pi. Okay, there is no direct link for how much people are spending or consuming and the level of inflation or inflation surprises, because unemployment it has been increasing, and at the same time also inflation has been very, very high for quite some time. So the Phillips curve here actually it's able to estimate with some accuracy the real fact that in Britain, as in other countries, there is some structural higher unemployment levels, and so the amount of consumer spending or the aggregate demand in the economy, it does not really explain properly the dynamics of inflation. Why prices keep rising if not so many people are in work and they don't have a penny to spend. That's pretty basic thing. So if we want to see the basic Phillips curve formula, we will know, for example, that pi, which in this case it's the coefficient for inflation, is the inflation expectation, some sort of what inflation we expect, minus b, which is the beta coefficient, and the difference in unemployment. Okay, some sort of thing there. Let's call it unemployment at the time t plus 1. Okay, that's looking forward or backwards, I don't mind. Plus some expectation terms. Okay, and in this case here we have we can write basically the equation. So what are our expectation of inflation? So we know that the intercept is 0.035 minus then what is the 0.0573 is the slope factor and the differential, the delta in the unemployment rate. So there is no, this is something that I've said many times already. So it doesn't matter for how much the exchequer wants to manage aggregate demand, okay? So because that is not going to control the level of inflation, okay? So making people unemployed, it doesn't push inflation down. It has a very, very marginal effect. So here we start to understand two important things, that in Britain, in the UK economy, it's not, as it is now, managing aggregate demand. It's not an effective tool to utilize in order to achieve, I don't know what, price stability. And on the other hand, because of Okun's law, so the weak linear correlation between economic growth and unemployment, there are some structural features in the economy for which people are unemployed because probably they don't have the right skills, or there are not the right jobs for the composition of the workforce. And we know that there are people who are voluntarily unemployed, ordinary citizens who are non-voluntary unemployed. They lose their jobs, they can find any work which is appropriate to their education or manual abilities, so forth and so on. So there is a mismatch, okay, in the labor market. There is frictional unemployment, so there is a mismatch between supply and demand of labor. So there is a supply of certain kind of jobs which are not really suitable to the people who are actually unemployed. It doesn't matter, it's low skill, high skill. There is a mismatch in the labor market. This happens anywhere in the world, because no place is perfect, and it depends. The economy, it's a dynamic thing. So it's like an engine, that a motor of a car that you want to optimize and you want to fine tune. So it's I mean, if I want to do the same example, if you are running an engine of a car which is using too much diesel, or it's using too much lubricant in the motor, you must repair it and optimize the efficiency of the engine. So one among these factors is that there is a very weak relation between economic growth and unemployment, the improvement in unemployment. Also because you can have, you can have a lot of work in the services sector, which is more capital intensive rather than labor intensive. And so probably you can realize to have more people in work, more citizens in work, if they are the investments into the economy, they are funneled towards actual production of things. There will be manufacturing, agriculture, industrial sector, energy sector, construction, so forth and so on. So it's also a question of how the economy grows. Okay, what is economic growth? And I made an example the other day. It's like there are two kinds of economic growth. Growth can be realized by prices that are going higher, while instead you can count GDP according to the material fact. Do I this year, or does the whole economy achieve in producing more goods and services than the year before? So do I have produced more stuff this year than the year before? That's a method to measure economic growth. So do I actually produce more? Do I have aggregate supply? Do I have more goods that I have produced, I have generated, I have made in the whole of the economy this year compared to 1 year ago? So this year I have produced 150, the previous year I have produced 100, so GDP has grown by 50 units. The bad way to look at the economy is that, okay, the past year I produced 100 things, okay, and the price was $1. This year I have produced the same amount of goods and services, but the price is $10. So GDP basically seems higher, but what it has basically changed is that you have a huge scale up of inflation. So that's the bad way of looking at economic growth. We will come back to this thing, which is very, very funny. So what do we do next is we want to start to see the structural behavior of the economy. And so, for example, we can use an econometric model, which is a VAR model. So we take our variables, these variables, they become some vectors, then we have some matrices, and we see what is the orthogonality and the covariance of these matrices, and we get to some results, and we get to some statistical fact. So here we have, for example, the net borrowing as a percentage of GDP, so which is the dependent variable. Then we have this other independent variable, which are the independent, linearly independent column vectors in this model. And so what happens? What that means here, we have to analyze what are the parameters which are statistically significant. So here, for example, we can see something which can be good. What that means is that for every one unit, let's see if I can make it a bit larger so it's more visible here, but I think it was okay. So for every, with one lag, so with 1 quarter time, 3 months lag, okay, because this model is backward looking. It's the structure is that these variables they use vector calculus, and they use a t-1 period. So the variables, they are scaled back by 1 lag or 2 lags, etc. And so we can see how past interaction of interpolation of these variables, what is the outcome in the following quarters. So here we see that for 1 unit of GDP, so 1 unit of GDP, 1 unit up of GDP, net borrowing goes down. It's minus 0. Let's make it 75, goes down. So what it means is that economic growth is beneficial to diminishing net borrowing. So if the economy is growing, even also simply for the debt to GDP ratio, okay. So if GDP goes up at non-varying debt, that means the net borrowing goes down. But that's a more wider extrapolation. What we see here, that if the economy grows, so basically the government does not need to do any borrowing to do any investment. Okay, so there is no need for spending. Right. Here, what do we see here? We have a 2-lag effect. So what that means is that for 1 unit of net borrowing with 6 months before, you see that there is a positive coefficient for the borrowing. So that means that when the government it's observed that when there is fiscal spending, this tends to propagate in time, even in the following periods. Okay, so here what do we have? Okay, we have something which it's called automatic stabilizers. So what that means is that if and when there is an unemployment increase of 1 unit, then we have a negative coefficient. What that means is that it's a negative effect on borrowing. So what that means is that the government needs to borrow for the fact that more people are unemployed. And that also happens here. Okay, so here we have a negative coefficient, and here we have a positive coefficient. So the positive coefficient, okay, my bad, of course, but the broader sense is that. So what happens is that when unemployment goes up, the government needs to borrow because they have to put additional money into the welfare state. Now with 2 lags distance, we see that the coefficient is negative. So theoretically, it means that it's having higher unemployment can decrease government borrowing. But we see that with the one lag distance, you have minus 3 point. These two basically are neutralized. They are basically almost zero. So does unemployment change government borrowing? Yes, it changes government borrowing. It depends how the shock is propagated into the economy. So the same we can see for GDP or inflation or unemployment. So they all interact within each other, the variables. Now the dependent variable is GDP. So what happens to GDP? So for every, this is very interesting. So for every 1% of government borrowing, GDP grows by 0.26. So what that means is that it's very, very simple and intuitive to understand. So when the structure, another, if you take pen and paper, because I have my dashboard here, so if you want to write down this stuff, you are watching this video, I suggest you to write it down, all these things, because they are very interesting. So 1 unit of GDP, of borrowing, fiscal borrowing fiscal, what does? It generates 0.26 of GDP. That's very, very interesting because it explains a lot of things. It explains that because the high stock of debt, there is a limit in pro-cyclical fiscal spending. So the fiscal multiplier. So it means that for how many times any government has tried to do fiscal spending to stimulate growth, then the final result is that for 1% of borrowing, you have 0.26% of GDP, which is not great, okay? You would expect ideally, I don't know, 0.5 or more than 1%. You would expect that for 1 unit of borrowing, you would have 2 units of growth, okay? But we know that borrowing, fiscal liquidity, there is another thing which is very interesting. Why fiscal spending doesn't work? Because you cannot expect to, if I am borrowing 1 billion in fiscal, and I want to do fiscal spending, okay? The government borrows 1 billion, but that billion, later on, the government expects to tax it. That's the tricky stuff. So later on, the government expects to tax what? The fiscal spending that they do. Okay? It's not a zero-sum game. It's not only outflow. The government is borrowing, it's pushing money into the economy, but they do expect to tax it back. So that's the big conundrum. And because they do expect to tax it back, the fiscal multiplier they expect to tax, okay, the fiscal multiplier, it's it's small. The fiscal multiplier, the net effect, is 0.26, okay, for 2 reasons. One is that investment is not immediately productive. 2, because any government expect to tax back the money that they put into the economy. It's that simple. So here, okay, for 1 unit of unemployment, then it has a negative shock with 1 lag on economic growth. But then we see here the same effect, that unemployment with 2 lag distance in time to GDP, it has a positive coefficient. They net to a smaller minus 0.1 something. But in any case, a rise in unemployment, it has a negative effect on GDP growth. That's pretty obvious. And GDP growth, it has a lagging effect. So it means that when you have 1 quarter with negative growth, it then propagates by minus 0.2. That's a coefficient factor that brings forward the negative growth from one quarter to another. So, and that is very difficult, okay, because let's analyze this thing. If we take that the government can do 1% of fiscal spending and then GDP is 0.26, it's this one, okay. But then if 1 month before I have a negative GDP, what happens is that if we net out the effect here, okay, let's say 6 months ago you have negative GDP growth. The government has a proactive fiscal policy. They start to do some spending, something. Obviously, from one quarter to another, you don't see immediately the numbers going. You can do some tricks, like the government can consume a lot. They can spend a lot, and they can buy a lot of goods and services, or they can post up some capital expenditure, and then borrowing goes up by 1 unit and GDP goes up by 0. So very simple. If GDP goes up by 0.26, right? By the previous quarter, growth was negative by 0.2. The net effect is 0.06. So it's very small. What I want to demonstrate is that when you have in the UK, as in France or Germany or Italy or Spain or wherever you want to look about, I don't know, Sweden, Norway, whatever. Whenever you have, but in this case it's in the UK economy, whenever you have negative growth, okay, the government can do spending, but then the marginal effect of raising 1% of borrowing and then netting out the negative 0.2 and the marginal positive multiplier, it's very, very small. So the crucial fact, of course, the crucial thing is economic growth. But in what terms we want economic growth? We want the constant increase of prices, and then we have inflation and we have economic growth, or otherwise, most probably, it's an aggregate supply dynamic, so that we don't make enough stuff within our economies, and so people are out of work. And it's very simple to understand this, because we don't do enough things or on our own, okay? And so people are unemployed because there is no productive activity. That's so basic. As I am unemployed, but I try to do something with the Econometrics research and YouTube videos, but then that doesn't show up in GDP. Anyway, what are the dynamics of inflation? Let's see, we have it here. So inflation here, if 1 quarter before, and these things, the Brits, they know it very well. So if 1 quarter before I have prices going up, of course they would expect that with the following quarter, the unit shock is even higher, it's 149. So if there is 1% in 1 unit increase in inflation in the past quarter, the dynamic is that there is 1.49 or 1.5 positive increase in inflation in the following quarter. And so that explains another things, that this data, it goes together with what we saw just 10 minutes ago, the Okun's law and the Phillips curve. So it doesn't matter how many people are working, because inflation, it's a phenomenon that feeds on itself. It depends on money supply. So if there is a lot of credit production into the economy, a lot of quantitative easing and all that kind of stuff, because of money supply, then inflation goes up. But this demonstrates that inflation lives on its own, and that inflationary shocks are determined by exogenous factors, I don't know, the cost of goods or imports which goes up, or trade barriers, frictions in imports, in movements of goods, or tariffs that comes from the US, willy-nilly 20, 30, 50% tariffs, absurdity of it all. And so it doesn't matter if you have tariffs and if you have Brexit, it doesn't matter if people are working or not, okay? So that's why people, they don't want to go to work, because it doesn't matter if they go to work. The economy does not improve, because there are other idiosyncratic factors which have been imposed and constrained on the economy, which are making this Aston Martin engine basically working so bad. So you try to put some lubricant and you want to run an F1 engine, an F1 motor with some ordinary fuel, okay? Or you want to run, you want to use an ordinary Vauxhall car and you want to put some high octane petrol. That would work, can work, but then what happens to the engine, to the car? It breaks down. So that's the problem. I see here clearly that inflation feeds on itself, and it does not depend on unemployment. That's not how it works. Here, okay, we see here the same thing, that 1 quarter before, if unemployment goes up, theoretically, inflation would decrease by minus 0.86, which is still it's smaller in itself on the inflationary shock. When inflation goes up, inflation propagates for many months and months and months and months and years, because it's the expectation of businesses, of shops, corner shops and any sort of business in the UK. Their expectation is that the costs in the economy will keep creeping, going higher and higher and higher, so they know that they get into a spiral of higher and higher prices. And so then you have demands from trade unions and they want higher wages. That's another kettle of fish. We will see another. Unemployment goes up, but with 2 lags before unemployment goes up, it has a positive effect on inflation. So the movement, the change in unemployment, it has a minus 0.06, which is very similar to the difference of if we have a negative GDP here, minus 0.2, negative delta in GDP. If I have 1 plus 1 fiscal spending, I have positive GDP. The net effect is 0.6. But the net effect between higher unemployment of 1 unit 6 months before, inflation goes up by 0.80, the following month unemployment still is going up, then you have a cooling in demand, so prices adjust down. This is how the economy is dynamic. Prices adjustment are dynamic. So the net effect of lowering inflation is very minimal, 0.06. It's very minimal in 6 months. So you can understand that you have, in this instance, you can have plus 2% in unemployment. Okay, let's make it in percentages, in 2 quarters in a row. Okay, but the negative effect on inflation is minus 0.06, which is very negligible in going down in CPI. So the risk is that, as I said also in other videos, is that you keep pushing people out of work, but you're not achieving anything in price stability. And that's very important if you want to operate, you want to take decision for the whole UK economy, for the whole population. You need to be aware of these things, because it doesn't matter, for example, how much fiscal spending you are doing, because then the multiplier effect it's very low, because the country, the economy, is already constrained by very high levels of debt. So there are a lot of things which are very interesting, okay? I understand it's very technical, and I'm pretty sure that this video is going to be very long. But it's very, very interesting for me. It's fascinating to the utmost point. Okay, so what do we have here? Okay, we see here, for example, with 2 quarters delay, also fiscal spending, it has a some marginal effect on inflation. So the government spending, the net borrowing, very marginally creates inflation into the economy, in prices. So here we have the dependent variable unemployment, so we are almost at the end. What happens? Okay, so here we see that if GDP, economic growth goes up, you see how unemployment goes down, but it's very marginal. And that goes back to Okun's law. So the delta in economic growth, it does not generate a dramatic, wunderbar improvement, wonderful improvement in unemployment. And that's important to understand, because it goes back to the fact how economic growth is created. It's just because of prices, or because more people are effectively in work and they are doing things. Okay, they are producing, they are making stuff. Okay, are you making it up? No, it's here, it's in the numbers. Okay, we see here how unemployment, it follows up. If you have 1 quarter shock in unemployment, then it follows up with a higher parameter, larger than 1. Okay, what do we have here? The same again, a positive expansion quarter on quarter in economic growth. It has a marginal improvement in unemployment. Unemployment decreases by minus 0.03. So the coefficient, it's small. It's not that great. And here, okay, we have the usual effect lag 2, lag 1 unemployment, because you have dynamic adjustment into the economy. And we have to see another thing, which is very interesting, okay? So here, we see how there is Granger causality. So what that means is that these variables, they truly cause each other to move. There is a very strong, quite significant, because the statistical value, the f-test, it's quite high. So it means that there is Granger causality between these variables. It's a technical terms. And here we have another thing. All roots inside unit circle is not true. So what that means is that there is not much, the modeling of this VAR is not really perfect. It isn't stable. What that means that the eigenvalues, they are not inside the unit circle. And it's like when, you have a radius, okay, the eigenvalues are not in the unit circle. I cannot explain this stuff. If you know it better, it does matter. So, so the eigenvalues are the, when you want to find, when you do matrix calculus, vector calculus, it doesn't matter. But all roots inside unit circle, false. So the unit circle is like having a circle of which has radius 1. But here we see that the roots of the characteristic equation that we derive from these variables, the roots are larger than 1, the modulus. So it means that the model is unstable. What that means is that there are all these fancy things is that to say is that there are structural shocks in the economy which cannot be adjusted by cyclical or counter-cyclical fiscal policy tools. So what that means is that you need structural changes in the economy in order to make it work better for everyone. Okay, it's basically having a car or the engine. You need to do, and you give it to the mechanic. So you need to do some structural repairs. Okay, we repair the foundation of the economy. I don't think so. You need to have some structural repairs into the engine if you want to use a high octane, high performance petrol, and you want to make the engine work properly and to extract the maximum horsepower from the high fuel that you inject into the combustion engine. Okay, so very really interesting. But what that means is that the VAR model here, at least this one, the eigenvalues, they're not really stable, so there are structural features into the economy. Here we can see the chart. So what is the impulse response function? So here we have GDP. So you see in the charts net borrowing. So what is, if GDP gives a positive impulse into the economy, the response function of net borrowing is to decrease. Okay, and then the 0, 2, 4, 6, these are the quarter forward, the following quarters, how the shock propagates. You have a large decrease in the first quarter, then you have a smaller improvement in the second quarter, the third quarter, the fourth quarter, then it propagates 1 year, 2 year down the line. Okay, so with the graphs we can see what is the magnitude of the impulse response function of these variables. So what we have understood up to now is that it doesn't matter if we are trying to manage aggregate demand or the level of employment into the economy. That does not change inflation in a dramatic way. At least okay, here you see how you have a dramatic change in inflation. That depends because if it's statistically significant or less. So there is no point in managing aggregate demand, and GDP, economic growth, does not come from a dramatic improvement in the level of unemployment, and that there are some structural imbalances into the economy which cannot be adjusted or repaired with the cyclical or counter-cyclical fiscal policy. Why? Because already there is a high level of debt, and the high level of interest rate and persistency of inflation, all these factors, and there are other exogenous factors. There has been Brexit, there has been an exchange rate shock, there are tariffs, there has been an energy shock. So all these things that pile on the economy, they cannot be solved by day-to-day or year-to-year fiscal spending in the budget. There are structural repairs that have to be done. And the structural repair, it's not raising tax by 20-30 billion pounds, because we can see in other models is that the exchequer, they try to the fiscal tightening effect, okay, it's not one-to-one. What that means is that the exchequer does a budget, they raise tax for 20-30 billion, but the net effect of that fiscal tightening, it then becomes less. It's 50% the nominal figure that they project on the budget. That's because of precise parameters that I have been able to estimate, and we will see that in a moment. So here we have the forecast error variance decomposition. It's very simple. So for each and every variable, here we have a net borrowing. Okay, so net borrowing, the effect in the economy of the net borrowing in proportion to GDP, they explain between 80 or 70%. So the net borrowing as a variable explains its lagged effect by between 70 and 80%. So what then here GDP explains the lagged effect of net borrowing into the economy by 0.12, 0.14. So it's the composition of the forecast error variance. So which components do explain the lagged effect and the error variance, so the error volatility in the variable. And that's the chart for the error variance decomposition. Here we have some sort of projection that the VAR model is able to do, and here I don't know, I cannot place a certainty on the forecast, because you have seen that the eigenvalues, they are not within the unit circle, so the model is slightly unstable, because there is, for example, variables such as inflation, they have a lot of autocorrelation, so they are not stationary, so there are a lot of technical things which make the thing not extremely attainable for the forecast. But anyway, because the VAR is not made for forecast, the VAR model, it's an autoregressive model which use vector calculus and the covariance matrices, and then it calculates, it wants to find the orthogonality between these vectors, calculates the eigenvalues, the eigenvectors, the lambda parameter, you have a root equation, you find the roots. It's absolutely interesting, but it's not made to do forecasting, auto-sample forecasting. Anyway, but here it's interesting because the forecast, for example, for Q3, negative GDP, I don't know where it comes from. Anyway, there are quarter forecasts of GDP of very low numbers, which I don't know. What is interesting is that the VAR model finds out that CPI slowly can decrease towards 3%, which is reasonable, not that slow eventually. I think prices can compress a little bit more, and that will be net borrowing per quarter, so you'll have to take an average every 4 quarters here. Here 4, 6, that's very large stuff. And okay, unemployment, it's already 5%, so it's projected to rise towards 5%, 5.2%. Okay, so what do we have next? So here I'm going to share with you something absolutely interesting. So we have 2 kinds of DSG models. So these DSG models, they are dynamic, stochastic, general equilibrium model. And I have another model which is a Blanchard-Quan DSG model. And these two, they are pretty much always utilized by institutional econometrics researchers, perhaps or almost surely in central banks, because they want to estimate how actually the economy works and what is the neutral rate of the neutral level of interest rate, because then the DSG model informs the policymaker in what is the structural neutral level of interest rate, and by knowing what is the neutral level of interest rate, the policymaker can assess the central bank has the knowledge and knows how much they can cut interest rate. Perhaps here it's very simple. Here we see that there is a 0.4 neutral level of interest rate. So the Bank of England, with this, let's say the Bank of England has been granted a gift like a Ferrari, an Aston Martin, a huge marvelous car, even, I don't know, a Vauxhall, whatever car you like, okay, a BMW, whatever you like. The Bank of England is driving a car, and the specs of the car is that the neutral level of interest rate of the car is 0.45. So what that means is that the Bank of England can reduce interest rate whenever there's a recession coming. Okay, the Bank of England can do very few cut in interest rate before going negative. Okay, if it's positive 0.45, the Bank of England can cut interest rate in the nominal interest rate by 0.5 percentage point, not 0.5%. Then it starts to go into negative territory, which means that the purchasing, the intrinsic value of the currency, it starts to become weaker and weaker and weaker. So the DSG model calculates what is, among the many parameters, what is the neutral level of interest rate. And we know now that the neutral level of interest rate, according to my models, which are not perfect, it's very small. It's half a percentage point, more or less. So it means that the Bank of England has very small room to cut interest rate in a recession or in any sorts of financial instability in markets before going negative. And that's another constraining factor on this wonderful car that we are driving. Please let me drive a V12 or V10, V12 combustion. I don't want electric motors. I want a V12 huge motor, some stuff like that. And so let's say that this motor, it has been going on for quite some time, and it has some constraints, okay? And we can lower the interest rate by 0.5, but then the efficiency of this car, it starts to lose efficiency very, very quickly. That's the metaphorical terms. And of course it's quite complicated stuff, but I'll let to make it simple also for myself. And okay, anyways, what are we looking at here? Okay, so it's quite a complicated model, but it's the must-have for any central bank. And I can guarantee that my models are 100 million light years better than the OBR and I don't know, even probably the HM Treasury, because I don't think they use this kind of modeling. So what do we have here? We'll start to understand that there is a component of financial wedge. Here you can see here the model calls it financial wedge or financial friction. So financial friction is that we have an R neutral, R star, which is 0.45. These are my guesstimates. Okay, then the corporate interest rate is 3.343%. So we have a 2.98% wedge. What that means is here it means two things. One thing is what I was saying before, is that basically because the neutral level here it's already so low, theoretically, the Bank of England can do minus 0.5 reduction in the bank rate whenever there is a crisis from this level, and already goes into negative. But because we have this large wedge between the bank rate and the actual cost of borrowing for corporates, even for SMEs, then the transmission mechanism of monetary policy between the bank rate and the corporate borrowing rates, it's impaired by the wedge, by the distance, the spread between these two rates. And so in monetary policy, in this respect, it has not been so effective monetary policy transmission mechanism for quite some time. And this alone explains quite a lot of why economic growth stagnates in the UK, because there is a financial friction component. There is a financial friction factor that will create some sort of credit constraint flowing into the economy in monetary policy terms. And yes, what that means is that the financial friction component factor, this becomes an additional cost for SMEs. So instead of having a 3-4% cost of borrowing, 5% cost of borrowing, they may have 6-7% cost of borrowing. And what happens next, for example, if these businesses, they experience that their assets depreciate. So if the leverage, this is technical, and I hope you can understand, if the leverage ratio goes up, then the financial friction component becomes an additional cost of borrowing for SMEs. And then if I have a business in England or in Wales and Scotland, and I'm borrowing at 5, then I have my leverage ratio goes up, then the bank comes to me and say, okay, I can extend your line of credit, but instead of 5, you have to pay 8% interest rate or 10% interest rate. That business says, okay, no worries, mate, I do not need that money anymore because the borrowing cost, it's way so high, I either shut business or I don't proceed with my project. And so you don't have economic growth. So this factor is crucial to understand why there is economic growth is sluggish. It's not because government is not spending, because we saw that government spending does not generate enough economic growth to improve unemployment, but there is a financial friction factor which constrains credit creation into the economy. And so here we can see here what is phi of y, then we have rho. Okay, so here we have 1 point, let's call it 112. Okay, let's make it larger. Here we have 0. It's this one, 0.28. Let's make it 29. Rho is 0.57. Then we have kappa, then we have psi. Okay, so these are strictly dancing for the central bank. Okay, so basically these describe the parameters of the Taylor rule parameters of the central bank's reaction function, or the assessment of the central bank, what they do with interest rate. Do they get drunk? They do not get drunk. They go for a drink, or more else, or chips and burgers. So what you would like to do? What I mean is pi, we know that is inflation. So the Bank of England, what does? If inflation goes up by 1, their reaction is here. It's 1.12. So they jack up interest rate by 1.12% because they want to, of course, they are aggressive. When they see inflation going up, the central bank, they want to preserve price stability, so they become more aggressive and they jack up interest rate by more than 1%. Okay. Then in the Taylor rule, you have some alpha and beta parameters, which to me they are calculated wrong because this has to be dynamically adjusted with the conditional volatility, etc. But that's another kettle of fish, etc. So basic terms, inflation goes up by 1%, the Bank of England comes out storming and says, oh, we're going hike 0.50, and so they become very, very aggressive with interest rate because inflation is gone up. Here we have phi or y of t, that's GDP. So what happens is that whenever you have stagnation into the economy, you see that the parameter that quantifies the reaction function of the Bank of England, it's smaller than 1. It's a tiny number, 0.29. What that means is that the bank, it could not care less if the economy is growing or it's not growing. They don't care about GDP, okay? Not that they don't care. They have a way smaller reaction or monetary policy assessment in response to the business cycle, to the fluctuation of GDP. Because GDP, okay, can be volatile. I don't know how much volatile can be. GDP is volatile if you have in something which is an economy which is inherently unstable, because you have some structural shocks. And what happens? Why Rachel Reeves or any other chancellor of the exchequer, they think that GDP figures, they are volatile. Whenever they go on the telly, they give the interview, right? They say, oh, we are disappointed the GDP unexpectedly was not growing enough, etc., etc. I just given you the reason why, okay? I'm not pretending to explain anything. I'm learning with you, okay? Because there are structural shocks which make the economy inherently unstable, and so whenever any fiscal policy applies itself on the economy with short-time changes, which can be pro-cyclical or counter-cyclical, those short-term adjustment in fiscal policies, and this all continues, as the IFS says, the continuous chop and change in fiscal policy, in taxation, in investment provision, etc. They make, of course, what is the outcome is that GDP figures are volatile. Because if you don't address the structural features, you know, the foundation, adjusting the foundation is not jacking up taxes by 30 or 40 billion. I will prove that. I will prove the concept. There is no concept. There is no pie in the sky of 40 billion black hole or stuff like that. I don't want to be rude, but fixing a short-term funding gap, it's not equivalent of repairing the whole fabric of the economy and the whole fabric of society. What I'm doing here, it's an in-depth forensic research about all variables, okay? And I don't need your beer. So, this one, phi of y, phi of y, it's y of t, it's economic growth. So, the Bank of England does not look so much at the cyclicality of economic growth, and that it's also somewhat it's a problem, and it's defined also by rho, because rho is the smoothing parameter for the adjustment in interest rate, and also defines also inertia, the inertia of monetary policy. How many times you would have heard some commentators or anyone who say, okay, the Bank of England has left rate unchanged. Okay, so you see that for a long time, the Bank of England just decided to sit and do nothing, to wait out more data. We wait more data, etc., etc., etc. So there is a component of inertia in the bank, in monetary policy, which does not make the bank adjust quite on time or just in time with the business cycle. Right? And so here, this phi of why you do that, Mike? It says that the adjustment of interest rate for what concerns GDP, it's minimal, okay? And that's the proof of the pudding, it's 2023, because inflation was very, very high, so the Bank of England, the bank was very aggressive with the interest rate because of high inflation. But in 2023, everybody remembers that the economy was in recession, right? And they could not care less about the fact that economic growth was sluggish. And by the way, we had recession also in Italy or Germany or France in 2023, in 2024, in 2022. There is no difference whatsoever, right? But the Bank of England say, I don't care. All right? That's my parameter, and I don't care. All right? That's how, in mathematical terms, in DSG model terms, that's what they do, and it actually reflects real life. I don't want behavior. I hate the term behaviors. Real life facts. So what is the monetary policy stance of the bank towards the economy? And so these raw parameters, it tells us that there is some sort of inertia. There is inertia in the system because they have an R star which is so tiny. They struggle to adjust monetary policy because the neutral level of interest rate it's a lot. It's way low, right? Why? Because there is some stuff as a 2.9 trillion pound public debt. So because there is these loads of debt, of course the neutral level of interest rate it's very, very low. And because we have high debt, what does high debt to our economies? We have low R star, 0.45. We have low fiscal multiplier. And these two things, they basically demonstrates why people in Britain, they believe there was austerity and this, that, and the other. No, it's because doing quantitative easing, it fills up the banks with bank reserves. And then they have another constraining factor, is the financial friction. So that monetary policy into the private sector, the monetary policy transmission mechanism is not that smooth. There is a friction. So even if the Bank of England cuts interest rate, the cost of borrowing for SMEs, it remains quite higher. The wedge, the financial wedge, it's wide. And so it's costly to take a financing terms from a bank to open a business. That's and to be profitable. That's the crucial thing. But here we have low R star, low fiscal multiplier. So what that means is that whenever you have an economy that it's working more or less, it's not a good idea. It's not a good idea to have a pro-cyclical fiscal policy, because the fiscal policy, the fiscal expenditure, it has a very low multiplier effect. So what it happens is that in an economy that is working properly, my idea, you have a low fiscal multiplier, you are adding to the high stock of debt, you have a very poor outcome of GDP, 0.25%, right, for every 1% of borrowing. And then what happens? That down the line, if you are in a crisis, then you have a low R star, low fiscal multiplier, you have added up a lot of debt because you have a pro-cyclical fiscal policy in, let's say, good times or in normal times. And then when the shit hits the fan, then you are in a recession, then you want to add even more debt, add more debt to already the high debt that you have. So my message is that pro-cyclical fiscal policy, or fiscal policy in general, just throwing money, it does not heal the pressure points of the UK economy. It does not repair the car. There are some other structural facts which are monetary policy. We have inertia in monetary policy, which is not bad. What is the major constraining factor is the financial friction factor, which constrains monetary policy. And here we have another estimation, which is more the kappa parameter, is the slope of the Phillips curve. And that parameter reinforces, so the financial friction, friction. So the psi parameter, 0.6, is the friction of the monetary policy transmission mechanism into the private credit creation. And so that means that whenever you have the leverage ratio that goes down, there is an additional cost of borrowing that goes on top of the cost of borrowing of SMEs. Now, SMEs, for example, they are borrowing 6.26. Okay, you see in 2024 how high was the cost of borrowing for SMEs, 7.5%, courtesy of the Bank of England. Okay. So now you know that I have downloaded the borrowing rates monthly average of UK residence bank sterling weighted average interest rate, new advances, so new borrowing rates for small and medium sized enterprise in percent, not seasonally adjusted. So the Bank of England needs to measure what is the cost of borrowing for SMEs, which is quite reasonable, right? And the financial wedge, or the financial friction, it's here. You can see it that the bank was at 5%, 4.5%, but there is a spread which is reasonable. But this financial wedge it's a structural constraining factor on the economy, on growth, because what generates growth is private sector. It's because businesses, it's here. Okay, well, if the cost of borrowing is high, it means that then the discount cash flow of any future project that I have, if I have to discount it by 6%, which is my cost of borrowing, then I need to have a marginal rate of return of at least 10%, right? And again, because the financial friction parameter here, 0.6, it's quite high, and we have a financial wedge between the R-star and the corporate borrowing rate, that creates additional borrowing costs whenever any SMEs, the leverage ratio goes down. So the riskiness of extending lines of credit to businesses goes up. So the borrowing rate here is 6%. Let's say that, the UK PLC, the SME borrows at 6%. They have a marginal rate of return of 10%. Okay, so net profit margin 4%. Okay, but if there is some financial friction component which is structurally into the system, okay, leverage ratio goes down, the asset depreciates, the cost of borrowing goes to, instead of 6, it goes to 8 or to 10. The business, it's living on a 10% net profit margin, a 10% profit margin. So the additional cost of borrowing, it basically cancels out the viability of the business. And these are the constraining, the real material constraining factors into the economy. The financial friction component and the financial wedge in monetary policy transmission from the Bank of England through the private credit channel of banks, it's a vital component. So if we make the shopping list, and you know that the fiscal multiplier, it's 0.25. Let's call it 0.25 for every 1% of borrowing. There is a financial friction, 0.6. We have Phillips curve. Let's call it 0. We take it here from the K parameter, 0.36. Phillips curve is flat. Okay. The Ocon's law tells us that GDP improves the delta in unemployment by 0.15. Okay, so an aggregate demand does not explain the level of prices. GDP can improve, but unemployment does not improve dramatically with GDP. You have a flat Phillips curve. you have a financial friction factor component, which makes the monetary policy transmission mechanisms through the bank lending channel more difficult for UK SMEs. So these are the structural among, and the fiscal multiplier is low because there is high debt. They have a high debt load, which is not dramatic because it's not Greece or it's not the United States or Japan. Yeah, so but I would say by a rough rule of thumb, okay, that if the UK manages, which is impossible, to bend the trajectory of debt to GDP ratio to 90% or below 90%, the economy improves. The economy, the engine, the structural composition, the structural fabric of the economy improves. But that's absolutely very difficult to achieve. So, with all these things, Phillips curve is flat, GDP does not improve dramatically, unemployment, inflation is not explained by aggregate demand, the fiscal multiplier is lower. You say, oh my God, you're painting a picture. No, I'm not Picasso. But then the structural features have to be improved. What that means is that by one budget or doing changing fiscal policy quite so often, it does not help the structural features in the economy, and also the continuous changing in the tax code or the investment position, all the chop and change in fiscal policy, they don't help, but they make GDP more volatile. That's the biggest reason. So I think I have some charts that I can share with you. Stuck in the middle with you, and I don't know what to do. I hope you are enjoying the video, and please subscribe, thumbs up, put a like somewhere. Okay, so you see here the charts are very nice. The financial shock transmission, it propagates for many quarters, and also through the monetary policy mechanism. Here we have, okay, what is the output gap, which is slightly negative, and inflation dynamics, they are pretty sticky, because the Calvo parameter defines the stickiness of inflation, and in the case of the UK, there is a lot of stickiness of inflation. And why there is stickiness in inflation? Because of this, because the SMEs structurally, okay, the structural feature is not jacking up 30-40 billion of taxes. It's the financial friction component. Why you have financial friction component? I will show you. It's not because of the Bank of England in isolation, right? But look here, you see that in 2016, it's true that the bank rate was way lower, okay? But Brexit, it's a component of financial friction, and Brexit, it's a component of the cost of borrowing for the exchequer. So the divergence between the risk of lending money to the UK vis-a-vis giving money to Greece, it has widened with Brexit because the financial friction component. Back then, SMEs were looking at 3.5% cost of borrowing. Then it went dramatically down. It was compressed during 2020 because lockdowns rates were very low. But then you see that you have a huge rise in rates. And now these rates, the cost of borrowing for SMEs, has diverged compared to the euro area. And so Brexit, the decision of raising barriers for goods, trade, services, movement of capital, movement of people, it's a bad component, it's a bad structural component for the UK economy. And so the stickiness of prices and the difficulty of UK SMEs to adjust prices is because of the cost of borrowing. And it's a consequence also of Brexit. Because the cost of borrowing, it diverges a lot, the risk premia diverges a lot from the Bank of England, and the monetary policy does not work effectively. And the Bank of England can do a lot in this instance. But Brexit is a component. It's a financial risk premium that it's embedded into the economy. So unwinding Brexit, of course, would bring the cost of borrowing for SMEs. It would be cheaper, it would be better, it would improve. So that's a structural. It's not Brexit because that thing. That is a structural component that the UK establishment, the Westminster establishment, has created. And now you know that the issue of firms adjusting their prices and always jacking up prices is because the cost of borrowing is higher, and there is a financial friction component which is due to Brexit, and also probably it's a matter for the Bank of England to do forward guidance and to do all sorts of things. And they announced in the financial stability report that they provided, they announced that they have decreased the capital buffer, the counter-cyclical capital buffer that they require for banks in reserves, so they freed up some lending space. It means in money terms, they freed up some credit availability to banks, provide credit to businesses. But these rates, they are high, and so there is an additional cost for SMEs. And the spread also is due because of Brexit. It's undeniable. That's a component that goes directly into the prices that then businesses have to put up for consumers. So that's a structural feature, not the black hole. That's the reason. You have it here with SMEs borrowing rates. And we can see with charts, the graphical response of the other DSG model, the Blanchard equation, the Blanchard 1 DSG model, which is very sophisticated model. And here we see what, for example, the credit spread and the financial condition index. So we see how the economy or the credit spread change across time. Here in this period they are mostly narrower, but the crucial component is the friction component in the monetary policy mechanism. Here we see, that the monetary policy is in a restrictive, still it's marginally restrictive for stimulating private credit creation. I believe that in the near future things will, the Bank of England will reassess monetary policy and they will understand where they are with the interest rate at least. Here that's very interesting, really interesting. All these charts are pretty much simple. We see what was the Bank of England rate across time, and we see here how the blue dashed line is the traditional neutral level of interest rate, how low it has been estimated. Of course, for those who are technicians and researchers or economists, they know that it depends on how you set the parameters. These have been estimated with most theoretical precision, that it's the nearest precision to what is the UK macroeconomic framework. By no means is not perfect. By no means is perfect or whatever. So you see here how corporate R-star, it's higher with financial friction, but still it's below the bank rate. So it means that there are some margins of improvement. And yes, these are the diagnostic tools for what is the output gap, inflation, and credit spread. So the comparison between the data which are uploaded and what the model extrapolates by using the Blanchard method. And we see here, for example, the skewness of the output gap is negative, so it's not a good thing. It means that most of the time there is the economy works below potential, and the kurtosis is very large, so there is a lot of, it means that there are some very wild shocks. But I'm pretty sure, I believe that the 2020 data, they are a mess, because you have minus 10% GDP, then you have plus 12, 14%. It's a mess. Yes, these are the basically how the model extrapolates the data with the Blanchard DSG method. And yes, they are pretty much very interesting. Here you see how the AR1 model, so it's the autoregressive model, what is the persistency with one lag regression of these variables. And so here I would emphasize the fact that output gap, it has also a factor of persistency in having the economic growth going below potential. So there are structural factors which can be total factor productivity, but one structural thing for sure is the cost of borrowing for SMEs. And we have cleared the factors which are due to monetary policy, forward guidance, financial friction, so risk premia, which is the cost of borrowing, inflation risk, inflation, interest rate volatility, default premia, liquidity premia. There are huge variables. There are a lot of variables which create, which are summed up into the financial friction risk premia for SMEs. Here we have some two charts which explain us what is the fiscal policy multiplier into UK economy according to the equation that had been implemented in this model. This is the you can see Blanchard-Perori model, and you see here 2-year cumulative multiplier for 1% as a fiscal spending increase is 3.26. But at the same time, you have the tax revenue multiplier. So if you increase tax by 1%, it has a negative factor of minus 2.44. So the net effect, it's minimal on a 2-year horizon. And 2-year cumulative effects, but it's based on 18 quarters, okay? But then it basically goes to zero after 10 quarters. So perhaps a little bit more than 2 years. So what that means that doing fiscal stimulus, and at the same time you need to balance the budget, and so you do tax increases. In the end, fiscal policy, an active fiscal policy, which has some pro-cyclical and counter-cyclical component to balance the thing, it does not lead you anywhere with GDP. And it does not help people getting into work unless you do structural specific investment which can raise the level of productivity. And that's not only for fiscal policy. It's also a matter of monetary policy through the private credit creation. And so narrowing the spread for the cost of borrowing. And these are pretty much, these are the same parameters, estimated parameters. And I'll just say that we have phi pi, which is the reaction. We can see here again. Pardon me if I narrow down the thing. Okay, we can see here the results. So that we see the same thing. Okay, so here we have the same parameters. Okay, Blanchard diagnostic. Okay, is that one? I apologize. That's the previous model. Okay, so the most important is having a dynamic modeling, which is based also on a random walk component that helps us understand monetary policy parameters. And I have been chatting for quite a long time now. So, model stability, the eigenvalue is larger than 1, so the model inherently is not perfectly stable because there are some structural factors which have very strong autocorrelation components or are non-stationary variables. So there are volatility components into the economy which then have to be adjusted structurally, but also when you do the modeling, you can try to optimize it at the most. Anyway, with the Blanchard DSG model, we have the same outcome. So that the neutral level of interest rate, I think I'll have to take another whiteboard. The neutral level of interest rate, it has become quite low, and so the Bank of England has very little room for cutting interest rate, and we have this famous financial wedge and financial friction component. So, and as I said, for example, that as an example, that Brexit is a direct, and the high persistency inflation component of the UK economy, it's a crucial factor of these additional inflationary costs for businesses and consumers. So now perhaps we can do also some sort of scenario modeling, which is not real modeling in this instance, but in simple terms, if for example this financial wedge is reduced, so the financial friction component is reduced to almost close to zero, what that means is that you can have that corporate investments would improve by 15%, and that crucially, what it does, this financial wedge here, it's a structural component for the potential output. So when this financial wedge is made approximate very close to zero, so there is not so wide spread in the cost of borrowing for businesses, so it means that the potential output improves by 2 to 4%. It's a very large range, and it may seem unrealistic. So we can take the more, let's take a range between 2 and 4%. But of course, we know that this financial wedge or the friction component cannot go to zero. So you can bring it to 1%. So potential output will increase structurally in a range by 1 to 2% in gross numbers. But I mean, the concept, it's very natural, is that the cost of borrowing for SMEs goes down. That basically fits through the economy and then can raise the potential output, because there is potential for more economic activity. So this component here, it's a structural component which is crucial to resolve and to improve, okay, which has nothing to do with taxes or spending. Of course, then what happens is that unemployment also improves, okay? You can have unemployment which can improve towards the narrow level, to the natural level or something like that, okay? So these are these are most of the reasons why the neutral level of interest rate and the financial friction component, they are very important to understand the functioning of the economy, the UK economy, why potential output is always structurally, it has been declining for a lot of time. It's probably because of quantitative easing and the expansion of debt. So the high levels of debt, they tend to force the neutral level of interest rate to 0.4, 0.5%. This is an estimate. It's not by no means. It's an absolute number. Okay, it can be a wrong data, but that's the estimate of my model, which is for sure is better than the OBR, and put a like on the video now. And so high stock of debt, high quantitative easing, banks have reserves, but the way they do private credit into the economy, there is a financial risk, liquidity premium risk, financial friction spread in the cost of borrowing for SMEs, which in turn becomes a no-no for economic activities which are not able to generate a 10, 12, 15% net margin, and so they are not able to absorb, among all costs, 6, 7, 8% cost of borrowing, and so there is no economic activity, there is no growth in the private sector, and people are unemployed, and that's because of the financial wedge, which also it's a factor that derives from Brexit, and so the capital outflows, the difficulty of doing business, the additional bureaucracy, so forth and so on, the limited access to the euro area funding models or the European Investment Bank. So all the capital inflows that the UK has enjoyed for a long time, they have been constrained by Brexit. And another important factor to evaluate is that the Brexit effect into the economy, they have propagated 16 quarters after 2020. That's, to me, for my own proof of concept, for my own research, I do not, not me, but because of all the making of the agreement, the TFA, then it was signed in January 2020. And, you know, by that time, immediately after, you have that there are no HGV drivers, there are visas for the healthcare sector, all sorts of problems. Lorries which are stuck in traffic at Dover, Calais, and all that sort of stuff. So the real shock into the economy propagates for 16 quarters after 2020. And you have an inflation outcome, you have an exchange rate outcome, and crucially you have a term structure risk premium, liquidity premium. In simple terms, the cost of borrowing. Gilts, the cost of borrowing on the UK government, it's an outlier compared to other G7 countries. And the divergence, it has become way, way more evident since after 2020, because then the new framework has started its machination, and then you see all the outcomes. You have high inflation, high unemployment, difficulty in the bank credit channels, and so businesses, they are not investing, and the term structure risk premium, it has diverged, and we could go on and on and on and on, but the matter of fact is that models, they are really precise, and so this Blanchard model, it's very precise. Here defined by the parameter that defines the Bank of England monetary policy reaction to inflation, it's even higher, 1.23. So they are very aggressive towards inflation. They are less so, way less so for GDP. It's 0.03. So they don't really care about the output gap. Raw parameter, we have the inertia in monetary policy. So, for example, if this raw parameter would be set, instead of being 0.47, would be 0.2, what that means is that the risk of inflation overshooting or undershooting, or the volatility, the risk of having inflation overshooting would be lower. Why? Because if I diminish the inertia of monetary policy, then tendentially it would mean that the equation, the Bank of England equation, would react more promptly to any price stability deviation from 2%. Okay, and that they will be quite aggressive in trying to preserve price stability. But because there is a component of inertia, tendentially the Bank of England, for quite a few quarters in a row, a few months in a row, they don't change monetary policy. They stay there and they wait. While sometime it was very, very evident in 2021. In late 2021, inflation was well 3.5%, but the bank was at zero in monetary policy. Okay, so that it explains the inertia, the raw parameter. In real terms, you see the inertia in the bank, which is very slow. So you have an overshoot of inflation, and then you have to catch up and to slap a 5% interest rate. And then what happens is that the economy goes into recession, but they don't care phi or y, they don't, phi, phi, pho, they don't care about the output gap. And that's the thing. But you see that here the Phillips curve slope parameter tells you it doesn't matter if you have what sort of level of unemployment, because that does not explain inflation, and you have a financial wedge and a financial friction component, which is an inflationary cost on SMEs, and it's a dampening effect on structural potential output. And so these are among the shopping list. If I can go back to the shopping list, do we have a shopping list somewhere on this whiteboard? Where is my shopping list? Oh dear. Oh yeah, we have the shopping list was this one. Okay. Here the financial friction component in the Blanchard model is 0.98. So it's very, very high. Where it is? It is lovely. Here, you see, it's very, very high, 0.94. So what are the structural features? Term structure risk premium, it's higher. You have 16 to 18 quarters of 2020 Brexit agreement shock propagating into the economy. The Phillips curve is flat. Here we have 0.25. On the other linear regression, we have 0. Let's put a range, 0.25, 0.26, 0.36. Financial friction, it's 0.6, 0.94. We are informing our modeling. The fiscal multiplier, it's low, and arguably, if we take the trade-off between the fiscal multiplier and the tax multiplier, so the draining effect, then fiscal spending, it's negative for GDP creation, for economic growth. So what do we have here? That the financial friction component and the financial wedge, it's a potential output constraining factor. So if the financial friction component is improved, the financial wedge here, then potential output can structurally go higher. This chart is very interesting because here you see how constraining in the 2-year cumulative effect of tax revenue multiplier, it's very large. So the net effect of fiscal spending, it's negligible. It can result to be negative for GDP because you have a crowding out effect of fiscal policy on the banking sector, because they have to absorb gilts into the market, sovereign debt, and they don't have all that capacity, lending capacity to give private credit to businesses, to SMEs. Okay, so fiscal spending can be negative, especially if you are doing fiscal spending and at the same time you're raising taxes. You are netting out, and the effect in the economy, it's not worth all the money you are throwing by raising debt and raising taxes. What definitely structurally needs to improve is the private sector credit channel. And linked to the private credit system, there is another component which I have overlooked, but it's equally important, which is the marginal propensity to consume or to save, and it's here, is beta parameter. It's the parameter that defines the household. So beta is 0.9955. Okay, so you say, okay, oh, it's very close to 1, it's a good parameter. No, not so much, because what this parameter defines is the consumer behavior. So it means that consumers in the UK, they value immediate consumption. They have an attitude of valuing immediate consumption compared to saving of here, something like this component, this parameter. What that means is that they prefer to consume in the near term rather than saving. And when saving rates, they are below average or they are not sufficient for banks to do private credit, that becomes also a component of the fact that probably it's easier to go to Greg's and sign up for diabetes and then stay on the NHS for quite some time rather than saving money. Okay, it's a bad example, but just I want to use an hyperbole. Allow me. It's easier to spend on McDonald's, Greg's, stuff like that, consumption, on takeaways. And then you sign up for some obese diabetes or some sort of health-related support, rather than saving money and thinking of doing something productive, or basically just save money in order to not to do a business yourself, but the concept of saving, or precautionary saving, it's not ingrained or embedded in the UK consumer. And so the aggregate pool of money that the banks have to provide credit for businesses is not what should be. That's simple. So there is a component of takeaways and signing up on diabetes with a lifelong diabetes with Greg. But the beta discount factor defines this one, that basically a household, they have a low level of patience for consumption, for postponing, deferring, waiting for consumption. Okay, they just consume immediately and they don't care. Right? I think it's pretty more or less it's pretty much the real life behavior. Okay, so that's another component, the low patience level of household with consumption. And so that then becomes, on the other side, becomes a marginally lower saving ratio than what ideally should be for businesses to have money and create jobs. So here we have, okay, the estimation of the R star, which comes out to be even lower, 0.36%. That's because of the huge pile of debt that whole Japan, US, the euro area, we all have on our shoulders. And so the R star goes lower and lower and lower and lower. We see that the output gap, it has been quite negative. So the problem here, which is something that the Bank of England has identified, is that because lower potential output, and when you have a negative output gap with a lower potential output, it's not really nice, because it basically creates a doom loop of persistent deficit. So the fiscal deficit accumulates, and so tendentially you have debt to GDP ratio which only goes up. So that's why the Bank of England, it has quite often emphasized the fact that a crucial structural component is to raise the potential output, which they saw that before the 2008 crisis, it was tendentially higher, between 2 and 2.5%. I personally, no, from the modeling that I've been doing, it was not high. More or less, it was 1.8, 2% perhaps. But now potential output, it's more something of 1.5%. So all this having a potential output which is it has become structurally lower. We have lost between 1.5 a percentage point of potential output. And so when the economy goes into negative output gap, then it's growing, it's stagnating. And again, the neutral level of interest rate is very low, so the efficacy of the fiscal multiplier, it's minimal, it's reduced. And then when you down the line, you change fiscal policy and you spend and tax, the net effect becomes negative. You risk of pushing inflation, you risk also pushing people unemployed, and then it's a negative feedback loop into economic growth. So it doesn't bring you into the right direction. So you need to structurally change the car so that the thing goes better. And I say that the risk premia, it's a component, the financial friction is a component, and so improving the potential of the economy, the potential growth rate of the economy, it's the crucial component which is on everybody's mouth nowadays. But the potential growth it depends on what do you define as potential growth. Is it's the growing level of prices, or is it actually making something? Okay, producing more goods and say more output from year to year, from 1 year, from the past year to the current year and the next year, so forth and so on. So then there is a more or less an assumption of current situation. Okay, no, the real rate now it's zero, it's marginally negative, so that's the assessment of the monetary policy stance, which says is restrictive, but I think we can jump on this. Okay, current rate of inflation. Okay, because it's measured differently, because inflation now it's 3.8. So effectively, the real rate it's very close to the neutral level of interest rate. So the Bank of England is actually moving into an easing mode. And so we can move on a similar method. We have a DSG model that it has been focused on the Phillips curve, on some new Keynesian modeling of Phillips curve, and then we can also see in real terms what is the potential growth that can convey the UK economy. We will see the short-term SRAS, which is the short-term aggregate supply, or the short-run aggregate supply, the long-run aggregate supply. So we see graphically in charts the potential growth level where it is, and it is what it is. So here what we do, we always take our 160 data columns, 140 plus rows, and we analyze the Phillips curve with the dynamic stochastic general equilibrium model, and we utilize a new Keynesian Phillips curve, a hybrid model. And so here the first thing, which are the two things which are very interesting, is that basically something that I have ranted about very hungrily is that in Britain most people have experienced that there is unemployment stagnation, there is unemployment or stagflation. Also in the 70s there was stagflation. So there is unemployment and high prices. So what that means in technical terms, what we have been talking about up to now, is that the economy economic activities of all people, they are below potential, okay? And so we have a gap which is negative, okay? Anybody could do more, can do more economic activity, and it can generate more money by doing work, by doing business. There is more business that can be done, but for some structural features that we have seen up to now as the constraining factor of financial friction, the capital flows which are not beneficial because of Brexit, the European structural funds, the lower, all that I've listed up to now, our shopping list. Another component is that the Phillips curve, we know that it's flat. And whenever we have Okun's law, which told us that even if the economy goes well, then unemployment does not improve dramatically. And it's also true that when we have a negative output gap, inflation goes higher. And also when we have a negative or positive unemployment gap, inflation also can be higher. So you can have high inflation and high unemployment. And we will see here how the blue line, it's the unemployment gap, because another kinky variable, which it's a technical factor defined as the narrow curve, which is the non-accelerating inflation rate of unemployment. So it's the neutral level at which you have a pool, a basket of people which are unemployed, which are looking for work or not looking for work, and then you have 30 plus million people working. So that level, which is an equilibrium level, it does not generate a price-wage catch-up spiral. So it's called a NIRU. So NIRU. Non-accelerating inflation rate of unemployment. But here we see, and so the NIRU level of the UK is around 4.2%, estimated neutral level. So when you have a delta of U which is positive, okay, now the delta of U of unemployment is 0.8 because unemployment is 5%. Okay, what happens is that still inflation is very, very high. Food inflation 4.9%, no matter what. And you see it here, the red line is inflation, which is going up, and the unemployment gap is going up. It's expanding. So that's a problem among the many problems. So what are the outcomes of the labor market, unemployment, inflation, consumption, etc.? So our DSG models always give us the typical parameters. So the beta parameter, which is the household consumption behavior, or our households value consumption of £1 today vis-a-vis having the same pound tomorrow. And so this parameter seems very high. Before I was mistaken. Annualized, this parameter would equate to 6.2%. Okay, so the households, they are not patient with consumption. They don't value very much a pound tomorrow, having money tomorrow vis-a-vis consuming immediately those money. And that is bad for the saving ratio. These are all the error terms, etc. So what is important for me to see here when I do my research is, of course, what is the reaction to output gap or to inflation, but these are estimated for the Phillips curve, so it's not really the monetary policy reaction function. What I want to see is how the New Keynesian Phillips curve or the hybrid model do perform. So what they tell me, I hate what they tell me. The parameters which are calculated here, you see gamma F and gamma B. So it's very simple. Gamma F and gamma B, it's forward and backward. And you see that the number that comes out is 0.50. So in the hybrid new Keynesian Phillips curve equation, we can inject these two parameters, and we want to calculate what are the value of these variables. And so this means that basically inflation expectation of the consumer, of the household, okay, not only consumer, the household. So we know the household has very low patience for immediate consumption vis-a-vis postponing consumption. But their inflation expectations, they are 50-50. 50-50, my. 50-50, not 0.05082, not 0.05044. So they see inflation, it's balanced. What is backward inflation, past prices, they expect future prices to be more or less 50-50 in the ballpark at the same level, or 50-50, they expect 50% to be the same past level and 50% some prices going up eventually. Okay, so inflation expectation in terms of backward looking or forward looking, they are pretty much in balance. Okay, there is no predominant component in the equation. Then, of course, what we see, what is the important variable for the Phillips curve is the slope of the Phillips curve, which we have here. So here you see that the basic model gives us the beta and the K parameter. So the K or kappa parameter, it's quite small. So it means that the slope of the line, it's very flat. It's almost completely horizontal, close to zero. But it means that there is not much of a trade-off between the level of unemployment and the level of inflation. I hope that you stick in your mind this simple fact. It doesn't matter what is the level of unemployment in the UK, price inflation will still be there. And there are many economic cycles or past periods, even the most recent periods, that do prove in the real lived life of people this simple thing. Now, what do we have here? This row of U and this row of R. So this row, which is a Greek letter. So R, it's for interest rate, and U, it's for unemployment. So this row of U, 0.85, identifies in the modeling a certain level of persistency in unemployment. So another feature could be eventually that unemployment is somewhat persistent in the whole economic framework. Okay, so the household, it does not value much postponing consumption vis-a-vis consuming today. So tendentially saving ratio, they are not they are below potential. Okay, then the household and the overall functioning of the labor market, the unemployment rate with inflation, they have the same backward and forward-looking expectation for inflation, the Phillips curve. The curve, the linear relation between the two variables, unemployment and inflation, is pretty much flat. So there is no trade-off. And I repeat again the same thing. You can push so many people into unemployment, it will do very, very little to bring prices down, because there is no trade-off between the two things. And that is crucial, because it's like you're pretending to repair a V12 Bugatti with a pair of scissors, an hair dryer, and just with an hairdresser tool. Okay, so you are in the wrong place, which is the mechanics shops, the workshop, with the hairdresser tool. That's the wrong. That's how things get wrong. Okay, that's the main problem. It's I want to repair a Bugatti V12 having a pair of scissors and an hair dryer. Wrong place. It's not an hairdresser. It's a workshop for cars. Wrong tools. So that's the problem of the approach of so many finance ministers to fiscal policy. That's because of ideology, mostly because my models, they are 10 million light years times better than the OBR, and put a like for me, please. So you see that the key findings: average inflation 2.7%, probably higher, but the crucial component is inflation volatility. It's 2.1, which sums up to 4.8. So what that means is that that's an headache for the Bank of England, because the average inflation is 2.7. Okay, we can work it out, but the huge crucial component is that prices in England or in the UK, in Britain, they are very volatile. They change quite rapidly, or they are prone to have shocks in prices, and that makes the whole thing difficult, more difficult than what it could be. Here we have unemployment gap range -1% to +1%, so that's the range. Output gap range, so we are below or above potential, but we know that the potential rate of growth of the economy, it has been decreasing. So the marginal high RPM going of our Bugatti, it has lost somewhat efficiency. So we are trying to have hairdresser tool into a car workshop. It doesn't work. It's structurally we are not going to improve the car, and that's the thing. And then you can say, okay, let's go for a hybrid model, a hybrid New Keynesian Phillips curve, and then say, okay, well, it's 50-50, it's 50-50. More or less the prices that were before, I expect the same prices going forward, maybe going higher, and it doesn't matter if I'm in work or not. That's the thing, right? So now, what are the actual potential levels of production? And so I try to estimate the short run here, aggregate supply, and the long run aggregate supply. So here we have the parameters injected in the model. We see that the output gap, it's pretty much really flat, and it has a plus or minus range of 0.025. Then we have an import, beta 2, it's an import shock, wage pressure, credit conditions. So of course the model, it's built to incorporate the effective problems, structural features which make the economy or our Bugatti not being so efficient. And we have an import shock, wage pressure, the credit condition, which I've been talking about blubbering for quite some time. So the R square, which is the significance of our linear regression parameter model, it's quite high. You see that the line almost perfectly fits the scatter plot, and so the squared error of these dots, they are very small. So the R square, it's good. All right. And here you see here how the short run aggregate supply, it's more or less in line with past periods. While there were some periods of let's say how can I say, larger short-run aggregate supply, but this chart, it's basically the residuals. So it calculates, it gives you what is the white noise, the volatility of the error terms across time in the short-run aggregate supply. So you can see here how this huge shaded pink area for before, after the lockdown, etc. So the residual, it's the residual error in the modeling. Residual distribution, you can see that there is quite a lot of volatility. So it means that the short-run aggregate supply, when it's measured, or the potential output in the short term, it can be also, it has a component of volatility. It's not really a fixed number. It can vary. So it's difficult to estimate. Okay, it's difficult also for the central bank to estimate the potential. Here we have a more stable, because we use some filters in the modeling. So the long run aggregate supply here, we have, it's more resembling the potential output, and we see here how GDP and potential output were pretty much squeaked to potential. But crucially, you see the red line here in these previous periods. Here you see how there is a margin, a buffer. Let's call it 2% buffer. So it means the long run potential output was 1.5%, 2% plus 2%. Okay, but since then 2008, you see that potential output goes down. The dash red goes down because GDP, it absorbs a huge compression shock in GDP because of the financial and the economic crisis. But then the dash line, the buffer that you had before, what the Bank of England very often explains, is not the same. So it means that potential output, it has compressed. The potential of the economy, it has compressed. Why? Because the stock of debt, it has been piled up. And the rate, the neutral level of interest rate is very low. The ability of fiscal policy to generate economic growth, it has been reduced. So the overall efficiency of the Bugatti, it's the Aston Martin, it's losing efficiency in generating horsepower, potential horsepower. So we need to do something, but we cannot use a pair of scissors and doing some color to the air and an air dryer and try to fix a car. That doesn't work. So here we had some brief period, but you see here 2023 how you had the slack. So the slack basically is when you start to see that unemployment goes above the Nauru level, and here we have 0.8%. So you have a slack component into the economy. So you have some capacity, productive capacity, which is not utilized. And you see here how wide was the slack in the previous period. But why? Because the potential output was higher. That's a bit contradictory, okay? Because lowering, marginally compressing potential output, it shows up on the dashboard of the car, on the panel. You have the car dashboard into the driving seat, and then the light that shows you, okay, there is slack, it doesn't show up anymore. Do you understand me? It's here. Here, potential output is very low. So the flashing light of, there is slack into the economy, it doesn't show up. While here, you have a lot of slack, a lot of underutilized potential, because the potential was higher. So there is a trade-off between these two things. And that depends on the policymakers. What is the intention? They want to expand the potential of the economy and have a more persistent, some sort of underutilization of productive capacity until and when they can do better, or you want to restrict the engine power. Instead of having a V12, you do now an F1, which is a V4 with 500, 400 horsepower. It depends. And then if you want a 400, 500 horsepower engine, which is a V4, V6, then the potential is restricted, and so you don't have the flashing light which says, okay, there is slack, but you have more overheating into the system, which is a false overheating because the potential, it has been reduced. Here we go to the most favorite thing, which is actual productivity and trend productivity, which has been measured with the ONS statistics of the output per hour growth in percentages terms. So you see here that there is, although is a lot of variability, there is a lot of seasonality also in measuring the data. You see here how the output growth per hour, it has going below zero. So it means that a negative output gap in the GDP figure, also it's a negative productivity growth. This is something that they know. The OBR has measured my models are better, and just put a like right now. And here we see the long run aggregate supply, how it's very close to zero. So it means that the potential, it has lost 1.5 point of potential. The long run and the structure breaks of economic events. So the long run aggregate supply potential, now it's at zero. So it means that the economy is stagnating as if it was already going at potential. And that's not good, because if the potential is zero, as soon as you do 1% deficit, you are adding public debt. That's how it is, and this stuff, it's very, very important. So we can see here in numbers, potential output growth 0.7. I cannot compare to other economies, but of course, if you are doing 1.5%, 2% deficit, and in the past years you have 4, 5%, 6% budget deficit, and the potential growth is 0.7, current output gap still is marginally negative. So you can see here that debt to GDP ratio will always, can always and only increase. That's a structural feature of having a potential output growth which is very, very contained. It's limited, it's constrained. So I would rather prefer to have a Bugatti V12 which runs at full power, and I have the proper tools to optimize and bring to maximum efficiency the car, aerodynamic, the engine, suspension, brakes, etc., rather than have a V4 hybrid model. No. I want a full potential. That's the thing. Allow me the metaphor, but taxing per mile the electric car, it does not structurally solve. It's like you see, plug-in hybrid, let's tax the car. Let's tax the hybrid Philips. It doesn't matter what you do. It doesn't matter, because the potential, the long run aggregate supply, it's too constrained. So there is potential that has to be created and restored into the economy, and there is a long shopping list of things, and you see here how what are the policy implications when you want to account for output gap responsiveness. So we have current output gap is negative. What is the responsiveness? It's very low responsiveness. But you have a import cost pass-through effect, some wage price pressures, and the credit conditions, so the financial friction component that I have illustrated before. And here we have a more pretty much expanded version of, the DSG model of a dynamic modeling of the Phillips curve. And here we have the visualization of the NAIRU, so the dashed line, it's here. I did other videos, and here you see how unemployment is diverging. So the delta in unemployment is 0.8. It's almost 1%. GDP growth is estimated to be at potential, slightly below potential, but not as good as should be, and it's visible in high inflation, high unemployment. So the problem is the structural feature is the is not managing aggregate demand, but is the long run aggregate supply. And I'm repeating what the Bank of England knows very well, and they have tried to explain these things a lot of times, or the long run aggregate of potential output. So I'm not in the place of saying anything, it's something new that we didn't know, etc. No, so I'm learning mostly all the time. And so that's the long run aggregate supply, so is the IS curve vis-a-vis the GDP, and the potential output. So we want the V12 Bugatti, possibly. Okay, I don't want the restricted F1 with 400 brake horsepower, and the long run aggregate supply, the potential output, they are not optimized And so the problem is that there is higher unemployment, there is higher inflation, okay? Because it's higher inflation, it's not solved by managing aggregate demand, but it's expanding aggregate supply. That's the basic thing here. So here there is a comparison, a policy rate and the real rate. So what it explains is that the Bank of England is here, but if we subtract the rate of inflation, the real interest rate is it's very close to zero. So it's actually the Bank of England with the next interest rate cut, when will be, probably they will move the bank rate into the real yield will be negative. So the cost of borrowing would be more, it would be easier, like a more accommodative for businesses. Okay, the Phillips curve, the scatter plot of Phillips curve, and okay, we have the DSG parameters. So we have the beta, which is the household's behavior in terms of consumption, and we know that the household is impatient. The inbuilt volatility, the flatness of the yield curve or the Phillips curve. We have a strong reaction of, there's the interaction with inflation and the output, and the smoothness of interest rate. Then we have the estimating, the classic Phillips curve with the OLS regression, and we see here that the constant coefficient, 2.8. So what do we see here? Something that I was repeating before is that, unfortunately, the jigsaw missing piece that it seems to me it does not stick into the mind of policymakers is that negative output gap. So the economy below potential brings high inflation, and so you see high inflation, how the economy is running at potential or marginally below potential. Here is the rolling correlation between the output gap, so the potential economic growth, let's say, and versus the actual economic growth and inflation. And so you see here that when you have a positive output gap, you have inflation at 2% or even below 2%, according to all the data from 1989 up to 2025. Okay, so you see all the scatters plots are here. So when the output gap is like now, which is very squiggled to zero, the economy is stagnating, you see how these dots are populating the range of inflation between 2 and 4. And how here you are populating lots of dots, you are populating up to 10%. So that's a crucial component, structural component. You have a rolling negative correlation between economic activity and prices. Okay, what that means that businesses can shut and you can go into recession, but that will not bring prices to 2%. So you can restrict the potential of economic growth for some sort of reasons, because what you do fiscal expansion, so you're crowding out private investment. What is the results? What it has been the results for many times this experiment has been tried is that basically the economy goes at potential. Nowadays is below potential, but inflation is high. You have high prices. Everything costs too much. Red line inflation here, output gap, it's squiggling to zero. So there is stagnation or stagflation. And that's the utmost crucial component, important to understand, because what you really want is to stimulate the aggregate supply, is to stimulate people in doing something, which is not only working, okay? That's another thing. Policymakers, they need, in Britain, but anywhere, they need to fix in their mind that if people are unemployed, it's because they don't find work, first of all, not because they want to be unemployed. So there is all this propaganda, which is false, that people, they choose to live on benefits. It's crap. There are other structural features into the demand supply of labor, which is a structural structural friction in the supply and demand of labor, which means that there are no people are looking for work, but they don't find jobs they can apply to. It's not only because of the hourly minimum wage. It's because probably companies, they need some people who are specialized in doing something, precision engineering, or they need software engineering. They need the employee to have particular characteristics or skills which they don't find in the labor market. So you have a structural friction or structural frictional unemployment, which is a mismatch between demand and supply. So what you need to do, first of all, especially in Portugal or in Italy or in Greece or in Germany, in France, is to reskill the workforce. And this is a concept which is well known anywhere, but it's only a point of discussion for the morning rounds. Okay, so unfortunately it requires something which is more organic, which is more structural, and one structural thing is making sure that the Bank of England is in the position of narrowing the spread for the SMEs borrowing cost. Okay, then you can do all sorts of legislation and do apprenticeships, stuff like that. But if you whack employers with higher taxes, they're not gonna hire people. So that's why it's the chopping and changing of fiscal policy, which has been repeated, rinse and repeat, rinse and repeat, rinse and repeat, and we do this laundry list all the time, which does not change the stuff, does not change the outcome. What comes out is that the potential, it's always lower and lower and lower, and inflation is going higher now, but the potential of the economy becomes restricted and restricted and restricted, because not the necessary structural changes are implemented. That's the real thing. So frictional unemployment, it's a question of supply and demand in the labor market, a mismatch. Okay, so if I'm looking for work and I do econometrics modeling, I will not apply to go to work at Starbucks or Greg's. I will stay unemployed for the rest of my life, but I will not do that job. I say, oh, why? Because you, that's my choice. Okay, so I don't do arbitrage or judgmental on other people's lives. But that's the thing. Okay, somebody who becomes unemployed, who was working at Deloitte, the day after they are not going to work at Pret a Manger. Is it that clear? So that's for all levels. That's for all parts of the economy. Okay, somebody who is a specialized hairdresser, he cannot go to work in a car workshop. Or somebody who is a plumber, he cannot go and work in a bakery, or he needs to be reskilled to be a baker, to know how to do sourdough bread and stuff like that, or a waiter or a cook. Okay, so manual job for manual work, people need to be adapted and reskilled when they lose work. And so the high rate of unemployment or the low output gap, it's persistent because the economy struggles to adapt to the business cycle. And so that's the idiosyncratic component. And another thing, okay, that if you are a breath, you basically ignore, but even policymakers, guys, the average unemployment rate, it's 6.2%. So structurally, the average unemployment rate is not 4%. The NAIRU, it's 4.2%. So the non-accelerating rate, inflation rate of unemployment. but the average rate of unemployment. So when Mr. Speaker, when a week ago, okay, so when we have here the data, quarterly data from 1989 till 2005, and I take the unemployment rate of those aged 16 and over, seasonally adjust, okay, and I only do one simple thing. I take the average of all the data. I want the average, and the number is already coming up, 0.062, which in percentages term it's 6.2223%. So the average rate of unemployment for the past 25 years, it's 6.2%. Okay, so I'm not sure that policymakers know exactly what are the potential risks. So that unemployment now is 5%, but it can converge to 6%, to the average historical rate of the past 25 years, okay? And we are excluding the unemployment rate of the 70s. So the average rate could be way higher than this, okay? So, to me, these are crucial things to have in mind. Not to have in mind, you have it down on a spreadsheet, all these parameters, and say, okay, this is the thing, okay? Change the oil filter, replace the liquid of the braking system, do the transmission, clean up the cylinders, the injection, map again the engine map, etc. All the okay, you understand me what I'm saying, or the digital part of the engine. So, or map again all that stuff. So you have a long shopping list, and these are all the parameters. So the average inflation rate, unemployment in the past 25 years is 6.2%. You know that the average GDP growth is 0.5%. Inflation is 2.8, but there is a volatility component of 2.1. The average level of interest rate, about 4%. Then you can do all your modeling and stuff like that. But I'm not sure, or I don't think changing fiscal policy every now and then is the remedy for structurally repairing the economy. So, as I said, because the unemployment trend in the UK is going higher, I would be very wary of the fact that you could have an overshoot of unemployment. You could have a unemployment which goes completely haywire, and you don't see this thing coming. So beware that the average rate is 6%. So I would be careful. And so with these charts, it's pretty much the same thing, but with added variables that can explain basically what I was saying before. So here we try to identify the dynamic interactions between the interest rate and unemployment, or the money supply, or the bank rate. I think it's sorry about that. I have so much material which is unbelievable. You can see here it's another very expanded institutional grade dynamic stochastic general equilibrium model. So we have an enhanced Phillips curve analysis. So we see here the same thing pretty much, so that there is here the point of tangency between the unemployment gap and inflation. It's very it's quite low. It's more than 0.25, 0.26. So the slope or the tangency point means that there is not much of a trade-off between the unemployment gap and inflation. not simply the level of unemployment. Then the model utilizes the standard Phillips curve, the New Keynesian Phillips curve, the hybrid New Keynesian Phillips curve, and we are able to see more or less the parameters, the results are pretty much similar. What we can appreciate in this modeling is that we have also the Calvo parameter component for the firm adjustments parameter with respect to their cost of prices. So here you see here how the slope of the curve is not really steep between the output gap and inflation. So here we have the Phillips curve, the classic model. Here we have the New Keynesian Phillips curve. We have a slope which is minus 0.36.1. And paradoxically, what tells us is that the output gap, even if it's a negative, it brings with it higher inflation. Okay, here it's the output gap, here it's the unemployment gap. So one chart here, it tracks the relation between unemployment and inflation and prices. Here the New Keynesian Phillips curve, it tracks the GDP, the output gap, vis-a-vis the level of prices. And these are the two crucial components which have been repeating on and on and on and on. There is no trade-off between the level of unemployment and inflation, and paradoxically you can have negative output gap and high inflation. Both things are totally missing in the OBR forecast and even in the budget document. Because I don't think that they do this level of in-depth research before doing fiscal policy. And so on and so forth. Whether it's this, that, the other, the one before, the one will come after, I don't have high hopes. That's especially and particularly because of ideology. So you take any country in the world, you take Japan, you take the United States, pick a politician, put this person in charge of the fiscal policy, they will be an utter and total unmitigated biblical biblical disaster. Let's put aside the apocalypse. Because they are ideologized. They believe in ideology and then they don't have research that backs their stupid ideas. So here we see how the evolution over time of inflation and unemployment, and in this past period you see that the curve of unemployment has been turning out on the upside. I've said a couple of minutes ago, 5 minutes ago, that the average unemployment rate in the past 25 years has been 6%, so I will not be surprised if the unemployment in the UK will go back up to 6%, and then it's all hell breaks loose anywhere in the country. So here we have the modeling, which is assessing here the 2% linear long-term price stability target, and what is the actual level of inflation and the expectation of inflation according to the modeling. And these should be marginally lower. So in charts, in graphical terms, we see how we have a positive linear regression between the unemployment rate and the bank rate. So what that means is that when the Bank of England becomes more hawkish and they hike interest rate, then you see how the dots, they populate the higher rate of unemployment, and the color basically defines the period of time for which unemployment and rates have been at those levels. Instead, of course, we have an inverse linear relationship, linear regression between the Bank of England interest rate and GDP. Because what happens is that when the Bank of England brings up interest rate to very high levels, 6%, 8, 14%, but nowadays they could go not higher than 5. So you see how higher interest rate here in this quadrant, we have very low growth, maximum 1%. But we have basically some periods where there is negative, -1, -2 economic growth. So you have recession. So those probably are some sort of stagflationary periods, or there is an economic shock, and then thereafter the Bank of England adjusts interest rate. So to have a higher rate of growth, you want to see rates at zero, you have very high GDP here. That's a lonely, solitary dot, because most of the rate of growth, they are all between 0 and 2%. You see how the dots, they populate this area, and how is the slope of the linear regression between interest rate and GDP. Here we have a very high straight line between inflation and interest rate, because we have a direct relation because of the Taylor rule, which is the monetary policy tool, with the interest rate reaction to any time that inflation goes above 2%. So you see how the dot, the scatter plot basically finds how the line is very steep. So there is a very direct relation between how the Bank of England sets interest rate and where is inflation in that moment in time. So you see here how in the past period you have dots for inflation being so high, 6, 8, or 10%, and rates at 5%. You see here 5%, inflation 7, 7.5. Even below 5% interest rate, you have inflation at 10%. So what that means is that the Bank of England could not adjust to an interest rate of 10, 12, 15%, vis-a-vis very high levels of inflation. Here we have the linear regression of what is money growth, money supply, and unemployment, GDP, and inflation. So we see here these charts, they are, I don't know how precise they are, because the model had some issues in drawing the data column of money supply. But nevertheless, we see how money supply, for some sort of reason, it can have some unconventional negative linear regression with the GDP growth. So printing money is not always a guarantee of positive economic growth. And so if we go again into the nitty-gritty of our beloved DSG model, we have the usual variables. So we have the beta parameter, the risk aversion parameter, the K parameter. So we know that the Phillips curve is very flat. Then we have the reaction to inflation, etc. Here we can also see what is the impulse response function of monetary policy shock vis-a-vis the output gap or inflation or interest rate, what is a demand shock or a supply shock into the economy. So we can see how 10, 15 quarters forward, how the shock propagates. And you see here, for example, when you have a restriction in monetary policy, how the output gap, the negative output gap, can last for how long into the economy. The same would be perhaps for the inflation, if you have a negative response function in inflation, or if you have a huge hike in interest rate, for how long it lasts into the economy. So yes, for how long it takes for interest rate when there is a monetary policy shock to normalize. And so these are explicative of the length of time that it's required for the economy to adjust. So in this instance, doing fiscal policy 1 year and then doing fiscal policy the second year, you see that for any shock into the economy, it lasts for many quarters, which are years. So the British public, they cannot pretend that things are fixed overnight. But improving the economy, it takes quite some time. Taking the assumption a priori, the initial assumption that I'm using the proper, I have identified the structural problems and I know how I have to fix the structural problem. So that's why the whole debate for any country, can be France, Italy, or the United States or Japan, or the cyclical adjustments that are made in fiscal policy, these are marginally effective. Quite often they are not so good for GDP. That's why we have a huge underperformance in most G7 countries, because the structural features are never resolved because they are too difficult. And it's very simple nowadays to use cheap slogans and say that the solution you pretend to have an easy solution. You cannot have an easy solution if you have beta, sigma, kappa, theta, phi, pi, phi, y, rho, the persistent, the smoothing effect of interest rate, and you want to know how many lags you have a shock, how many lags it persists into the economy. So the complexity of a country of 70 million people and a broader economic framework, an open economy, capital inflows, outflows, or so forth and so on, and then any ordinary politician is not able, it does not have the cognitive and cultural, the knowledge, the ability to solve the structural things, because they don't understand it, basically. That's the real thing. And I had the proof. If you open the OBR forecast, they don't understand a dry fig of anything. So again, here we have the estimation of the Phillips curve, the New Keynesian, the hybrid model, and we have pretty much the same results, although these ones, some root mean square error, they are quite large for some reasons, so there is a question of calibrating the model or the data, stuff like that. But anyway, so what do we have? The results are pretty much accurate. So we have the same thing here. So we know that the gamma, F and B, so what is the expectation or household behavior vis-a-vis the past inflation, the backward-looking or forward-looking inflation, they are pretty much neutral. It's a 50-50 trade-off. Here we have some richness to the model, because with the gamma parameter we have the delta of the wage component and the material component, on how this as a marginal cost can explain the trade-off in the unemployment or the output gap and inflation. So we see here that the wage component, it has a marginal cost of 0 point something. So there is also wage component into the consumer household expectation of inflation, the beta factor, which is the household component or propensity to consume immediately, to value consumption now vis-a-vis saving for later. Sorry, I need some water probably. Yes, and so you can have a flat Phillips curve, but there is some component of cost push factor, which is the wage component, that explains more of prices rather than the level of employment. So there is a cost push factor into the British economy, which is directly derived from wage pressures, because of the price-wage catch-up feature. And yes, we got the same levels. We see here, it's very interesting to contextualize this data, because the average interest rate of the Bank of England is 4.2%, and that goes exactly to the fact that we have estimated that the neutral level of interest rate to be somewhere around 0.4%, 0.45%, 0.36%. So the neutral level of interest rate is lowered a lot. That's why the nominal rate on average has been 4.2%, because the Bank of England here has room for minus 0.5%, 0.4% of reducing interest rate in the upcoming monetary policy decision, then already now it's easing a little bit. Also for the counter-cyclical capital buffers. But anyway, in real terms, it has half a percentage point room of cutting interest rate from its average levels, because R star is very low. And those are really important concepts if to understand how to raise the potential of the economy. And for monetary policy especially. So that's really crucial in a sense. So going forward, I have estimated the whole sorts of things, and we can see here how it has been growing, the debt to GDP ratio. Okay, and then if we go above the 90% level, which can be defined as a high debt threshold somewhere like that. But if we look at Japan, there is no definition for high debt threshold. So here we have measured how the primary balance work it's cyclically adjust vis-a-vis some measure of debt stabilizing measures. And so it's probably what you would say is the fiscal headroom or stuff like that. Here we see what are the periods of fiscal sustainability gap. We see here how most of the time this pink line here, it means that an adjustment is necessary for fiscal policy in the primary balance to basically stabilize the debt level, okay? Because you see here that the debt levels have been consistently growing since 2009, 2008, 2009, mostly 2009. 2008, nothing was growing. So you see here what is the curve of growth of public debt to GDP. It's more than £1.5 trillion. So, so you can, of course, the modeling finds that 90% of the time, 85% of the time, you are in a situation where there is a need of fiscal adjustment, and the rolling coverage of any fiscal announcement also it has been always focused on where is the deficit, how much taxes we're going to raise, this, that, and the other. Always because mainly because fiscal policy has been looked through the lens of what is the can I have a pro-stimulating fiscal policy, so a pro-cyclical fiscal policy? Do I need to raise taxes so I can have a counter-cyclical fiscal policy? But there has never been a structural direction. Okay, it's always been like on a circle, going round and round in a circle, or a feedback loop of one government to another, a feedback loop of, you did this, you did wrong, now we're going to change your decision. So there is a feedback loop that goes round and round of based on the politics, on the ideology of the time. And we see here how over the period there has been a 64.3% change in debt, and the average primary balance it has been negative or minus 0.5%, which is actually a very truly contained level. And so, of course, always with dynamic modeling, we try to see what is the fiscal sustainability, because when potential growth is very constrained and the economy struggles and there are no structural changes, then what happens is that fiscal stimulus it does not achieve the necessary economic growth. So we do some more research, and we find macroeconomic research literature. We know that there is a Among the many models for fiscal sustainability analysis, we have the Cottarelli-Jaramillo framework. So we want to assess with a particular equation the fiscal sustainability across time, and we can do it by basically in very simple terms. We want to identify the delta, the rate of change of the debt to GDP ratio according to time t. And so I think I have to zoom out a little bit. Okay, so we have the real interest rate minus, I forgot the minus, the growth rate. Then we have the debt level at time -1. Okay, then we have again, sorry about that. I think I have some more space. Okay, so we have the level of debt to GDP ratio in the previous period, so at time -1. So we have the sequence of primary balances, because that's what is important at time t, plus the S and F, which is the stock and flow adjustment. So the level of debt, level of stock of debt, and the flow, which is primary balance, surplus, or deficit, and these are measured at time, all at time t. So you see that there is a time component which is backward looking for the debt to GDP ratio component, and with this that kind of equation, we get to this nice, very good-looking charts, and we see here how pretty much is similar to what we saw before. So we have the evolution across time for all the data available of the debt to GDP ratio. We see what is the, let's say, is the change of the stock and the flow. Then what is the green line is the actual primary balance. So how the flow changes. So you have a surplus or deficit. So most of the time, primary balance has been in deficit. For that happens for all governments. If we take Japan, there is no such thing as fiscal discipline. So we see here how we have with this model, we can see what is the fiscal multiplier in different economic environments. So we have the zero or lower bound period with 142 observations, and the fiscal multiplier is marginally negative or close to zero. Then we see that in recession, we have a positive fiscal impulse or multiplier. And in a high debt environment, as it is now, above 40%, we have a negative fiscal multiplier or fiscal impulse. So what do we know is that fiscal policy, it's a good method for when there is recession, but then in high debt environment, fiscal policy, it completely it loses efficacy. It's not really a good of a stimulus for or an impulse for growth. So that's another thing that we have proven again and again and again by doing in-depth work of research of all macroeconomic variables. And I can show you here that the 240-270 debt to GDP ratio that the OBR projected, it's total bonkers, because here we have a more precise measure, which to me also it has to be taken with a pinch of salt and a lot of precaution. Why? Because here it's very simple. You see that the line here, they are straight line. So the model in extrapolation, it projects a linear path for debt to GDP ratio, right? But in real life, you see the debt to GDP ratio, it's a curve. because it lives of economic cycles. So it expands, it contracts, it depends what is the economy. So there is no linear or exponential progression in debt to GDP ratio. But anyway, we can make a broader idea of what is the projection. So theoretically, even with growth-friendly measures, in doing fiscal stimulus, debt to GDP ratio in 10 years time horizon, it could be as high as 137%. Okay, so you see here, instead, if you have front-loaded stimulus, like what it has been done now, so they are projecting to spend a lot, 7.4 and 5% in 2026, 2027, as a sort of fiscal stimulus. So they are front-loading the expenditure and they are back-loading the fiscal consolidation. But this method, it leads to high debt to GDP ratio compared to a growth-oriented or a gradual adjustment in fiscal consolidation. So front-loading fiscal policy, according to the Cottarelli-Jaramillo framework, it's not a good idea, my dear. It's not a good idea, because in high debt levels we have the fiscal impulse or fiscal multiplier actually can turn out to be negative stimulus because of a crowding out effect of fiscal policy, and then down the line the debt to GDP ratio can result to be quite higher than you are projecting, because front loading is not does not seem to be a good idea. But without any adjustment, the trajectory of UK debt to GDP ratio will be north of 160% in 10-year horizon. Now, you see how these lines, they are straight. So I will not take it for a sure thing. Right? But nevertheless, they give us the framework of cognitive framework of understanding, okay, what am I doing? What the government is doing, it's front loading, so it's spending a lot now. Okay, probably the outcome it's higher debt. Or the government is doing a growth friendly measure, probably okay, we're gonna grow more, and so that can be contained. Well, the government is not adjusting anything, okay, we're gonna be saddled with that for or submerged with that for a long time, so that is gonna grow. So these are quite extensive modeling or research of all sorts of measures in the economy, all the scenarios, or what is the debt trajectory, what are the structural features. You can see here how the rate and growth differential have evolved across time. So you see here how all the past period, since right before the great financial crisis, you have a positive growth rate differential. But then here you have, after 2008 or 2009, you have a negative growth rate differential. So that are the dynamic that go together with the lower potential output and the accumulating stock of debt vis-a-vis the flows, and the fact that with high debt levels, fiscal policy is not really effective. There is no immediate trade-off between unemployment and inflation. It's a question of the long-run aggregate supply. There are financial constraint components in the monetary policy or the borrowing cost for SMEs, and that is due to Brexit and to other shocks, because there is a divergence in the risk premium of the yield curve. So what that means is that in other terms also means that all these measures, tax receipts and just hiking a tax by 1.2 points, those are dynamic projections. And on a not that, those are static projections. Okay, so if you have a certain level of tax and you put 1% more on that kind of, corporate tax, whatever it is, that is a static projection. But the actual intake of tax is not a question of the Laffer curve. It doesn't matter the Laffer curve. The matter is that the tax revenue multiplier, it does not bring in the tax, the flows that you are projecting when only doing a static assessment of the expenditure and revenues. And so for that reason, then there is a persistent narrowing of the fiscal buffer, so forth and so on. So it's it's important is that of having a dynamic and structural and dynamic assessment or framework in which you can see as a whole how the economy works, and then probably understand that fiscal policy, it has very limited scope in some circumstances, and probably what is required, it's more stimulus from the private sector. And yes, I have so much that it would take me probably days to explain everything. But nevertheless, it has been a humongous pleasure and honor to record the content here. And yes, please subscribe, leave a comment, thumbs up for me, and enjoy the winter and Christmas period. Have fun, and see you to the next video.